The technology sell-off accelerated today as the Philadelphia Semiconductor Index officially plunged into a technical bear market. The index has now retreated over 20% from its June high, marking a 10% drop this week alone. This represents its worst weekly performance in over a year. While the broader Nasdaq index also fell, the pain was concentrated in chip makers, indicating that crowded momentum trades are finally flushing out. A primary trigger for this sell-off is regulatory pressure from South Korea. Financial regulators there raised margin requirements and suspended new single-stock leveraged ETFs to cool speculative trading. This forced sudden, large-scale retail liquidations in major South Korean memory manufacturers, specifically Samsung and SK Hynix. Algorithmic trading programs quickly spread this selling pressure into U.S.-listed semiconductor names, triggering broad liquidations. Adding to hardware concerns, Chinese AI model builder Moonshot AI announced it will open source its Kimi K3 model on July 27th. This model features 2.8 trillion parameters and currently ranks first on the front-end Code Arena benchmark. By offering high-performance coding capabilities for free, this open-source release directly challenges the high-cost subscription and API models of U.S. developers, raising questions about the return on expensive hardware. This combination of regulatory pressure and valuation concerns triggered a historic shift in market structure. Over the last 3 days, U.S. equity momentum experienced a 3.3 standard deviation unwind. This is one of the most severe momentum sell-offs in 27 years. Diversified portfolios faced systematic deleveraging as single-stock implied volatility surged past 120%, forcing automatic selling regardless of fundamentals. These liquidations overshadowed a major cooling in U.S. inflation. June headline CPI fell 0.4% month-over-month, its largest monthly decline in 6 years. Core CPI also eased to 2.6% year-over-year. Yet despite back-to-back cool inflation readings, the 10-year U.S. Treasury yield remained stagnant near 4.6%, showing that bond markets are focused on other risks. That bond market stagnation is explained by rising energy prices. The Strait of Hormuz is effectively closed following a U.S. blockade on Iranian oil. This geopolitical escalation sent diesel prices up by more than 20% over the past 2 weeks. The threat of renewed energy inflation acted as a strong counterweight to the cool CPI data, driving capital out of tech and into oil stocks. This transition comes just as corporate capital spending enters the spotlight. For the upcoming earnings season, investors are demanding clear monetization plans. Google's full-year capital expenditure is projected at $180 to $190 billion, nearly double what it spent in 2025. Tesla's margins must also stay above 15% to maintain investor confidence, while GE Vernova needs to show it is converting its grid backlog into revenue. At the same time, we are seeing a strategic split in big tech. Hyperscalers like Google and Meta are focusing on developer models and leasing massive compute infrastructure. In contrast, distributors like Apple and Microsoft are outsourcing model development in localized markets. Apple, for example, is partnering with Alibaba and Baidu to power its AI features in China, avoiding the high cost of local model training. Beyond software, the long-term technology race is shifting to quantum systems. According to the Hoover Institution, quantum volume, the main performance benchmark for quantum computers, is growing tenfold annually, outpacing classical hardware growth. The race is split across computing, sensing, and communication. This transition is forcing a repricing of traditional tech valuations. Netflix, for example, dropped after reporting its second quarter earnings, despite solid cash flow. The pullback left the stock trading at roughly 23 times free cash flow, based on $12.5 billion in guidance. This represents a reasonable valuation floor, showing that investors are now valuing actual cash flow over speculative multiples. The combination of tech outflows and rising energy costs has accelerated a rotation into defensive value. Capital is flowing out of hardware and into sectors with stable cash flows. Apple's market capitalization recovered to $4.9 trillion, competing for the top valuation spot, as investors increasingly treat it as a defensive AI play with lower capital expenditure risk compared to cloud peers. At the same time, institutional fixed income portfolios are preparing for a structural shift in interest rates. Hoisington Investment Management recently cut its portfolio duration from 20 years to under 1 year. This duration reduction by a historically bullish bond fund suggests a high conviction that long-term yields will remain elevated due to sticky energy inflation and high government deficits. As we head into next week, our focus remains on three main watch points. First, we need to see if the semiconductor index stabilizes or if deleveraging continues. Second, we are monitoring the 10-year yield to see if it breaks out from its 4.6% range. Finally, we will track the developer response to the open-source Kimi K3 release on July 27 to gauge its impact on commercial AI pricing.